Hey, welcome back everybody. So we're going to be talking Palantir stock today in this video. So Palantir had their Q4 2021 earnings report and they're down roughly 15%. Two key metrics that were looked at and is pretty much looked at for any company on an earnings report is how did they do with revenue? Did they beat it or not? And how did they do with EPS or earnings per share estimates? And a lot of people were expecting that Palantir would beat the revenue expectation, which they did. However, they fell short on EPS, which a few people were also expecting. But it didn't matter because the analyst wanted a certain number. It didn't happen. We are in an environment right now where if you miss either of the estimates by even a little bit, the company's getting punished pretty hard. But that's not really 100% what we're here to talk about. I am going to run a DCF model on Palantir. Now, I don't really care what kind of models or valuations people have been trying to run on Palantir. The fact of the matter is the only true kind of model you can use to project what a company's worth is the DCF model. You need to have the ability to project future free cash flows out and then discount them back based on your rate of return you want. I've seen people use other models that they, literally must have made up, and they make no sense and a lot of the time overvalue companies, which is a bad idea because then you may be overpaying for growth. Now, I must put a little disclaimer here. The discount cash flow model is normally pretty sensitive to the numbers you put in. You normally want a lot of consistency to make a DCF model more accurate. Well, in Palantir's case, there has not been a lot of consistency with numbers, so it definitely makes projecting a little more difficult. However, this is the first full year where they actually have positive free cash flow. 2020 had negative free cash flow, so even though we don't have a lot of consistency, we can still run the model and at least get some sort of idea. I also want to make it abundantly clear as to not upset anyone, no matter what the end result is, that I'm going to be using very aggressive metrics. Alex Karp has said for the next 5 years he expects 30% revenue or more, but around 30% revenue on average over the next 5 years. Instead, I decided to project 30% revenue growth over the next 10 years. Also, normally on a DCF model, you would be projecting revenue to then net income, to then free cash flow, and then projecting out from there. However, their net income is negative, so we cannot use net income for this model. We do, however, have the free cash flow that's positive for 2021, so I'm going to base it off those numbers. So I'm going to base this off of their revenue of 2021 and their free cash flow of 2021. We're going to create what's simply called free cash flow margin. And that's when we take the free cash flow and divide it by the revenue. Now, normally you want to at least take the last 5 years when you're creating a margin. So you take like the last 5 years of free cash flow and divide them by the last 5 years of revenue, and you'd look at all those margins and kind of find an average or pick the lowest one to be conservative. However, in this case, we only have the year 2021. And if we go ahead and divide the free cash flow of 2021 by the revenue of 2021, we reach a free cash flow margin of 27.5%. So I am going to assume a free cash flow margin of 27.5% over the next 10 years projected. I do want to say 27.5% free cash flow margin is very high. That's what it happened to be for this 2021 year, but usually that's a pretty high margin. Just for context, if you look at Microsoft for the year 2021, their free cash flow margin was about 33%. But if you look at Apple's free cash flow margin, it was about 25%. So we're essentially saying that we'd be okay with the next 10 years of this free cash flow margin being higher than Apple's. Now, in Palantir's defense, they have a business model like no other, so I could not really find a company to compare it to when it came to free cash flow margin. So I just went with two big tech stocks, which tend to have pretty good margins. Again, we don't have a lot of consistency to look at when it comes to prior years, or really much of anything to look at all. So I am assuming the 27.5% margin for the next 10 years projected. That could end up being much higher than it should be, or it could end up being lower. I really have no idea to tell, but we're just going based off what we have. And we must also clarify one more thing before we go to the DCF model. When it comes to Palantir's shares outstanding, there's about 2 billion. However, Palantir is constantly diluting their shareholders with stock-based compensation for their workers. They've been doing this, and they said that they're going to continue doing it for the foreseeable future. So because we know that they're going to do this, we do have to make shares outstanding a part of this DCF model, and we need to find a fair way to increase the shares outstanding. So if you look at Q4 of 2020 versus Q4 of 2021, that was actually a 15% increase in shares outstanding. I have to be honest and say that I could totally see it increasing by that much over the next 10 years easily, because a company like this is just always going to dilute the hell out of their shareholders. It's just what happens, and they've said they're going to do it with share compensation to their workers. But I didn't want to go 15% because that would really make the shares outstanding a pretty large number by the end of 10 years. I decided to just go with 5% share dilution on average over the next 10 years. And at the end of 10 years, that's going to get us to about 3.2 billion in shares outstanding. I personally could see them diluting it way more than that, but we'll stick with this number. Okay, everyone, so without further ado, let's go ahead and run this DCF model based on 30% revenue growth over the next 10 years and a free cash flow margin of 27.5%. Okay, everyone, so we're going to grow that revenue out by 30% growth rate, and at the year 2031, 10 years later, that would be about 21.2 billion. We then apply our free cash flow margin to those projected revenue numbers. So we apply that 27.5% margin to all of those projected revenue years. We then discount it back by my rate of return I use, which is 12%. Also want to put it out there, I used a weighted average cost of capital of 9.3%. You can get this figure from finbox.com, which gives a low, mid, or high weighted average cost of capital. I always choose the middle one. In this case, it was 9.3%. And after everything is said and done, we get an intrinsic value of 11.92, or about a fair value of $12 a share today. So look, anyone who's watching this that likes Palantir, who really believes in this company, I do not want anyone getting upset at this video. I just let the numbers speak for themselves. I made pretty aggressive assumptions saying 30% revenue growth over the next 10 years. And I also made a pretty aggressive assumption that the free cash flow margin would stay at 27.5%. Again, I used a rate of return of 12%, which you should always want higher than 10%, or you might as well stick with the ETF or index fund. But look, guys, this is a legitimate DCF model I ran with what I would argue was pretty aggressive bull case assumptions. And it comes out to about $12 a share fair value, which is close to what we're sitting at now. That arguably doesn't leave you with much upside right now. However, I will say that if you buy into the stock right now, it is sitting at about fair value according to these aggressive bull assumptions. I don't know what to say. Look, I'm not a buyer right now personally because this doesn't leave me a whole lot of upside based on the assumptions we made in this model. And I am not trying to trigger anyone who owns Palantir stock or is a big fan and a big bull of Palantir, but this is just proof that you can overpay for growth. People who were buying this in the 30s and even 20s. The numbers were not even good as they are now for full year 2021. People were buying this stock in even the 40s, and that was based on like the 2020 numbers that were out that were really not that good. People were not buying into the stock before based on valuation. It was all about hype and FOMO. And even now, I would argue that people within the last few months were also buying into the stock based on hype and no true valuation, and not really looking at any sort of model that would project a value for the company. Well, here's a model here, and it's with aggressive assumptions. I let the numbers speak for themselves always, so that people can't get mad at me. If you truly do believe in a bull case for this company, and you think that somehow they could do even better than the aggressive metrics I used in this model, then by all means, this is definitely a buy. And even now, based on these pretty aggressive assumptions I made, it is at fair value right now. If anyone was buying this well above 20, don't feel too bad. It's happened to me in the past too, when I just didn't teach myself how to value a company yet. No matter how great Palantir's future is, and I'm sure it will be great, you still have to value a company based on numbers. Heck, until the earnings even came out for full 2021, I couldn't even attempt to run a DCF model because the numbers wouldn't allow it. You really need to run an actual valuation on a company before you make an investment. Please don't invest based on a story, because the story can be great, and it is a good story with Palantir, but you can overpay for growth. So I know a lot of people are very hype on Palantir and love the company and love the stock they hold in it. So if that's you and you're watching this video, please remember, I just run the numbers and I let the numbers do the talking, but I do enjoy putting this information out there to hopefully help educate people and give them a better idea of where the company is at for fair value. Okay, so let me know your thoughts down below on Palantir. Do you believe the growth will be even better than the projected 10 years in this model? Do you think Palantir is currently a buy? Let me know in the comments. And if you feel that a video like this adds value to your day, go ahead and sub to the channel and give the video a thumbs up. Okay, everyone, glad I was finally able to do some kind of coverage on this company because I've been very curious to. But with that, we're going to end the video. Y'all have a great day.